Let's talk to Matthew Yeates, a quantitative investment manager for Seven Investment Management. Very good morning to you, young Matt. Right, Federal Reserve last night, Mr. Powell. Good job, bad job for the markets?
Yeah, well, we've heard a little bit from Mr. Powell in the last week or so. You know, we've got the minutes from January, which were written by Mr. Powell for the first time, and then we've heard in his kind of report back to Congress, his speech back to Congress. It's not a full changing of the guard, but it certainly seems the case that Powell is probably, well, first and foremost, he's from the markets, okay? So he has a private equity background. He's not a pure out and out academic in the same way that Yellen was. We've already seen in Mr. Powell's kind of writing of the minutes a potential to be a little bit more, let's say, less opaque with some of the wording. So this idea of Fed speak potentially is a little bit kind of, you don't need a degree to interpret his minutes in the same way that you did with Yellen and Bernanke before that. But what's he saying about the economy? Well, he's not afraid to say that the economy, he feels, is strong. I think the thing that the Fed, I suppose, has to point out in the front of its mind is this inflation question. This is the question that the markets potentially got a little bit scared about in the last month or so. And I think with this strong growth, there's the potential for inflation. And he is recognising that in what he's saying. And the Fed are beginning to recognise that the spectre of inflation that's been missing for so long is potentially coming through. I think one of the really interesting things that he pointed out that the Fed was now considering is this idea of what is the inflation target for the Fed. Okay, so what are the signals that the Fed are looking for before taking action? We know that for so long, the Fed has almost had this 2% number kind of plucked out of thin air, you know, this single point estimate that they're aiming for. There's been discussion or real discussion for the first time in a while about should that be a point estimate or should that be a range that the Fed are aiming for. I think in just predicting and tying yourself to kind of one single number, you're almost setting yourself up for failure. When is inflation going to end up at 2.00000% or whatever you're aiming for? So I think recognising the targets and recognising this changing of the guard in the way that Powell's thinking about inflation is an important sign for markets.
Okay, so we've had this sell-off recently, okay? Is this because inflation's at 3%, growth is at 3%, and there's another mighty number 3, so 10-year money, inflation and growth?
Well, I think markets and market commentators just tie any narrative they can to a sell-off. Almost, you know, it doesn't necessarily have an explanation, but people start tying lots of different things, and you know a sell-off is getting really bad or people are getting really nervous when they're tying 10 different stories to the same sell-off. You mentioned 3 just there. The very fact that we're talking about 3 different reasons suggests that nobody knows which one it is. I think the inflation story and certainly inflation and bond yields rising a little bit quicker. That links back to that story we were just talking about in the Fed, was the thing that seemed kind of most suggested by the markets as the reason. I think when we talk about the reason for the market sell-off starting and the reason for the market sell-off becoming much worse, they're 2 different stories though. So the thing you didn't mention there, I suppose, was just the extremely low volatility level we were coming off. You know, how sustainable is it to have the VIX below 10? You know,
when was the last time the VIX was in backwardation? You know, it's
exactly, and I think the story there and the story that lots of people were citing for a long time is that there was lots of almost pent up tension in markets with this idea of short vol products. You know, people just selling volatility outright, even when it's at all-time lows. I think in many respects the market sell-off we had could be healthy for the longer term trajectory for markets. You know, we've had a little bit of a washout of some of these tensions that were in the background. People have taken pain, and if you're picking pennies in front of a steamroller, as many of those short vol products were, then maybe that pain's justified. What I think will come through now is that strong growth story you were talking about. We've got a tax cut on the horizon in the US. We've got fiscal stimulus on the horizon. People think that's going to add about 1% to GDP next year. All other things equal, that's got to be positive for markets. The tax cuts clearly have a direct impact on earnings and a direct impact on companies' ability to pass that back to shareholders. They have a direct impact on growth as well, so the ability to grow those earnings over the long term should also be improved. That's positive.
Okay, it's multi-asset, 2018, the $1 million question. Where do I put my money?
Okay, well, I think against that backdrop that I just cited, you've got strong growth, then I think you have to continue to at least be a participator in the equity markets.
Is that for the fear of missing the last 30% upside in basically innings 9, let's say?
So I think you've got to look through to the economic fundamentals, and the economic fundamentals remain strong. I think the real fear investors should have is, what is the opportunity cost of holding equities? What is the alternative? So when we talk about multi-asset portfolios, when we talk about balanced portfolios, we're really talking about a mix of equities and bonds. If anything, I think for multi-asset investors, the big pain came before the sell-off. If you were a holder of long-dated government bonds, 10-year government bonds, you destroyed about 2 years' worth of capital or income rather, in the 2 to 3 months before that market sell-off. That, for many low-risk investors, that would have been a much bigger source of pain, potentially, than that equity market roll-off. So I think the outlook going forward is one where you want to be a participator in that economic growth, so you want to be holding equities. I think when you're thinking about how to hedge that equity risk, I think conventional government bonds are potentially going to be troublesome. So I think maybe look towards inflation-linked bonds, where you have some protection against, if inflation spikes up and the nominal yield curve rises, you're getting paid for that inflation boost as well. So protecting equity market participation with things like inflation-linked bonds, or maybe dipping a little bit into some options to protect your portfolio where there isn't that caveat around what the interest rate curve does, especially when volatility is kind of falling back to what are historical averages, especially if you exclude 2017.
Well, I read gold is old. Okay, that's not the answer anymore. Bitcoin, crypto, and we haven't got time to talk about that today. But would you have any gold in your portfolio at the moment?
We at 7IM, we hold some gold in the portfolio. I don't think it's without caveat gold. I think just relying on gold as a diversifier, you're probably opening yourself up to too many specific risks there. But I certainly think gold, especially when you're talking about an inflationary environment, gold has a place as a one of your diversifiers. I don't think hanging nominal government bonds, I don't think hanging your hat on inflation-linked bonds, I don't think hanging your hat on gold or on puts, each of those individually is going to provide protection and diversification. But I think people need to think a bit more broadly about diversifiers. And so I think inflation-linked bonds, gold, some long-dated treasuries, and maybe some put options as a portfolio diversifiers. I think that's where you're going to actually get protection that you can rely on a little bit more in the next sell-off. Because investors that were holding government bonds only, nominal government bonds, through the recent sell-off, maybe didn't get the protection they were expecting when they'd already seen capital losses in the 2-3 months before that.
Matt, as always, brilliant stuff. Thank you very much indeed.
Thank you.